Welcome to this lesson on planning for retirement and education funding. Today, we will be reviewing vehicles for retirement and education funding and how to calculate retirement and education needs. This is by no means a complete review, so please read the assigned chapters in your textbook. First, we will start with planning for retirement. Let us first review retirement vehicles afforded by employers to employees. We start with a review of a defined benefit plan, or a DB plan. Over the last 20 years or so, this type of retirement vehicle has lost its frequency of use. However, depending on the type of job opportunity like the government, it may still be an option. In this case, the employer contributes and assumes the investment risk. At retirement, individuals receive an annual benefit based on an actuarially developed formula. Here is an example of how to calculate. The next broad category of employer-sponsored plans is a defined contribution plan. The main difference here is that the employee is responsible for contributions and investment decisions in the account. The amount received at retirement is directly based on the amount in the account and not on salary. There are three broad types of individual retirement accounts, or IRAs: a deductible IRA, a non-deductible IRA, and a Roth IRA. Traditional IRAs are pre-tax, meaning you contribute money before taxes. Conversely, Roth IRAs are after tax, meaning you contribute money after taxes. Roth contributions are never tax deductible, and earnings remain tax-free and without penalty if two conditions are maintained. The two conditions are the initial contribution was made more than 5 years ago, and the money is withdrawn from the account at 59.5 years of age, you are dead or disabled, or you are using the money for a first-time home purchase. Taxable investment accounts offer liquidity and access that traditional retirement accounts lack. They are flexible and allow investors to benefit from favorable tax rates. This slide provides a general overview of the process of calculating retirement income needs. The following 8 slides go through the process of calculating retirement income needs. There is no recording during these slides, so you can work at your own pace. We now turn our attention to education funding. We will review a few of the options that are available to consumers. Specifically, we focus on Coverdell, 529 plans, and savings bonds. Coverdell accounts are education savings accounts that have a $2,000 contribution limit per year. These accounts must be funded before the beneficiary reaches age 18, and assets must be withdrawn by the age 30. Since the contribution rate is low, even a small annual maintenance fee can impact the overall investment return. A 529 plan is an education savings plan operated by a state or educational institution designed to help families set aside funds for future college costs. There are 2 types of 529 plans: a prepaid tuition plan and a savings plan. In a 529 plan, earnings grow tax-deferred and distributions are tax-free for qualified expenses. Qualified expenses include post-secondary education. There is no annual limit, so total contributions can be very high. 529 plans are flexible. Funds can be easily transferred and you can invest in another state's plan. For example, you can be a Texas resident, invest in a Utah plan, and send your student to a college in New York. U.S. savings bonds and I-bonds are another option for education funding. See your text for more information on the different options available for education funding.